Hey everybody, Austin here, building a $10,000 to $1 million transparently right here on YouTube, sharing every step of the way. I'll share that portfolio in just a minute. Also want to talk about the incredible, amazing power of dividend growth and how that can be absolutely wealth and portfolio transforming over time. And then in that lesson, I'm going to share two dividend growth stocks that I love right now and one that looks undervalued that I think is a trap that investors should watch out for. All right, first up, a quick look at my portfolio. What you'll notice is I own growth stocks here, so I do not own these dividend stocks that I'm talking about. I just want to be transparent about that. But I'm a student of investing. I love reviewing stocks, which is why I'm reviewing these stocks. I do full portfolio reviews on this channel where I go through every company in my portfolio, my thesis, the valuation, my potential return scenarios every Friday. So subscribe to the channel and would appreciate you liking the videos to help other people find them. Yesterday, this was Tuesday in the market, we were down 5%, $3,200. I am not concerned. This is a long-term portfolio that I'm building over time. And I actually prefer that these stocks stay cheap for longer while the businesses continue to execute and perform well so I can buy more and more shares. When they start to get expensive, that's when I start to really consider owning some of these top dividend growth stocks. Over the last 21 years into it, and they've really only been paying a dividend since 2012, it started out as a 3.7% dividend based on the share price at the time. At least that's what this is saying. But since they've grown their dividend at 17% per year almost in 2021, those shares that you bought in 2012, the dividend kept growing. They were now earning you 14% on your cost. So if you would have put $10,000 into shares in 2012, you'd have gotten 615 shares. That would have paid you $369 in dividends at the time that year. If you would have just held those 615 shares through fiscal year 2021, they are now earning you $1,453 per year in dividends alone for that 14.5% yield. That's what I'm talking about, the magic of dividend growth. And then we can see that because of that dividend growth and because the stock has outperformed, it has crushed the S&P 500 since 2001 for almost a 17% annualized return. Turning a $10,000 initial investment, you've gotten almost $10,000 paid in dividends. The growth of the share price has given you $237,000 for a total return on $10,000 of $247,000 over 20 years. Life-changing performance. I've talked about Nike recently on the channel. I'll get into the valuation in just a second, but showing you the same thing. That initial 2003 yield on cost, the yield you were getting is under 1%. Those same shares held through 2021 into 2022, you are now earning 17% per dividend per share that you owned back in 2003. That's the magic and the power of dividend growth. Hasn't done quite as well as Intuit on a percentage basis, but still amazing returns. $10,000 into $166,000. So for the rest of the video, we're going to talk about a few ways we can look and evaluate if a company can continue to grow its dividend at a high rate year over year, as well as if these stocks are undervalued or overvalued and if they might be a good buy. And then at the end, I'm going to share one stock with you. I'll give you the name of the stock. It's PoolCorp. That looks really undervalued, but really it might not be. And I'm going to tell you why I think that and how we can figure that out with stocks moving forward and not fall into the trap, which is kind of a value trap, thinking something's undervalued when really earnings could drop and it may actually be overvalued. Okay, the first thing I love to do, let's check out the dividend safety of Intuit. They currently pay a dividend yield of 0.7% for a 98 safety rating with 15% dividend growth in August of 2021. And we can see just from this chart, they've had strong dividend growth. And Intuit, just a quick summary, and you can look this up on Yahoo Finance or anywhere, they serve small businesses. They have Credit Karma, ProConnect, QuickBooks, TurboTax, those different types of businesses. Okay, this is how we start to tell if a company can continue to grow its dividend and not lower its dividend, which is like the worst thing a dividend paying stock could do. Payout ratio, we want it to be low. Theirs is 21%, very low for most companies. Forward payout ratio is 20. That means that their earnings are expected to grow faster than what they're already giving towards dividend growth. And so their payout ratio is actually expected to go down, which is great. Net debt to EBITDA, net debt to capital, we just want these to be low. They score low in both of those categories, and we want to see a sustained dividend streak. One of the weaknesses, if you evaluate Intuit on a dividend model, is that they don't have a long history of paying their dividend, but their cash flow and their business is so strong that I'm confident, and their payout ratio is so low, I'm confident that they'll continue to pay it. 9 years without a reduction. Ideally, we want to see more than that. Recession sales plus 1% from 2007 to 2009. Okay, I don't think that exactly repeats itself in the next recession, but it proves that their model, the things that they offer, are relatively recession resistant. They're not just discretionary that somebody could just turn off and not need. If businesses and people are using these products, they rely on them and they need them even in recessions. Recession return, it was only down 29% compared to a 55% drop in the S&P 500. If we are entering a recession, these are the types of stocks I want to own. Dividend growth, 15% in August of 21. The last 5 years, they've averaged 14% per year. And an uninterrupted streak of 9 years. We talked about the dividend growth already. Okay, that is the dividend safety and payout ratios for Intuit. Let's jump into Nike. 99. So we could see it's one better than Intuit, but both extremely strong at 98 and 99. They yield a little bit higher, almost 1.2%. 11% dividend growth in November of 2021. And their dividend safety rating, 30%, so a little bit higher, but still low for most companies. Forward payout ratio is 33. That means that with their dividend increase or earnings decreasing, payout ratio is going up a little bit, but not a concern there. This is the type of dividend streak we love to see, 37 years without a reduction. They increased the dividend during the last recession, the great financial crisis. Sales dropped 6% per year. I would expect sales to drop a little bit more than that in another recession, just because it's a much bigger company now. They were in like hyper growth phase back then, but still minus 36% from 07 to 09 versus minus 55% for the S&P 500. 11% latest dividend growth. Last 5 years, they've grown 12% per year. Last 20 years, 15% per year. That 19-year dividend growth streak, 37 years without a reduction. Fantastic numbers. Are these stocks overvalued or undervalued right now? This is fast graphs. What we're paying attention here is the black line, which is the current stock price. The blue line is the average PE ratio that the stock is traded at over whatever time is shown on this graph. For right now, it's the last 20 years, from 2001 to 2022, really, and then estimated into 2004 in terms of they estimate their earnings based on analyst expectations. That's the blue line, their average PE. The orange line represents a PE of 17, which is the earnings growth rate over time. So if we just look at this chart, the black line is currently above the blue line, which tells us it's technically a little bit overvalued compared to its average PE ratio. But what we have to look at is that over this time period, the earnings growth rate has been 17%. And for the foreseeable future, the next 3 years, they're actually expected to keep that earnings growth rate. We can see here that the PE ratio shot up way too high in 2021. So I want to look at a different number for what I think this average PE ratio should be. So if we look back, I think a safer average PE ratio is somewhere between 23 to 26. We'll go with that. That's 10 to 20% lower of a PE ratio than what its average is. Right now, it's trading at a blended PE ratio of 33, so a little bit high. But with their expected earnings growth rate, it's not as crazy as you think. This is their forecast. It builds in the estimates for the next 3 years, and then we can run it out and look at what the prices would be at certain PE ratios. So if we go out from here, a 33 dropping to 27 by July of 2024 would still get a 7% annualized return and a 16% total rate of return. Ideally, we want to wait to start a position in a stock like Intuit, in my opinion only, until it gets down to around 340, 350. I don't go for like specific price targets, but that would be a PE ratio of 29, down from 33 right now. That's about a 10 to 15, 20% drop from here. If it dropped 10% and maybe we got down to around 350, 360, I would start to get a lot more interested. At 386, it's not quite as exciting, but it's also not extremely overvalued. So I have no issues if somebody, wants to have a long-term position in Intuit. All right, Nike, we can see right here, it's actually come down a lot. They just reported earnings. I covered earnings in a previous video, so check it out in the feed. They did announce a share buyback, which is huge, so love to see that. And I think a lot of Nike competitors are going to get hurt in a recession. Nike will too, but they probably come out stronger because of their brand power and their balance sheet and that buyback. So something to think about there. But the PE ratios come down a lot. This stock traded at up to a PE of 47, insane. It's down to 27, which is closer to that 23 number, in line with its average PE ratio. But again, let's kind of take a look back and just see if something maybe makes a little bit more sense because it got so insane here. I would say 21 to 23 is perfectly reasonable and fine, in my opinion, for Nike. So a little bit high right here. If we just look at a PE ratio of 27, getting down to 23 is, 15, 20% drop from here, kind of just like Intuit. So again, we're going to forecasting. We could see through 2023, they're actually expected to have no earnings growth, but then 21 and 21%. This might come down in a recession or, in the macro environment. But let's take it down to that PE ratio of 22. And you're, again, looking at an annualized rate of return of 8% for a 25% rate of return. So right there, Intuit and Nike, they both look a little bit overvalued, but because of the quality of the company, the quality of their dividend, their track record, I think it's okay if people are invested right now. If they want to start a position now, just knowing, hey, I'm going to build this position over time. It might drop. I'm comfortable with that. Or we could wait, and with Nike, it would be waiting until it gets to around, I'd say between 88 and 95 a share is kind of like where I would think it gets really interesting. But not sure it gets there. And if somebody really wanted to start a position in Nike for the next 20 years, are you really going to care if you bought it at 95 versus 102 or 90 versus 102? I don't think so. But there's a lot of people that have different appetites for volatility and risk. And so, a decent range, I think, is between 90, 95. But somebody started a position now, hey, totally understand that if that's a long-term position. That's kind of how I invest anyways. Just a quick look at Morningstar. Intuit gets a 4-star rating. They think it's at a 24% discount right now. Nike, 4-star rating. They think it's at a 23% discount. All right, we talked about the two strong companies. They look a little bit overvalued, but their track record and the industry that they're in my opinion, shows that they're reliable. And I would rather pay up for overvalued stocks if they're true growth stories. PoolCorp is one that looks undervalued. Let's just take a look at it. Looks way undervalued compared to its average PE ratio. But I think it's actually a much riskier stock than Nike and Intuit. First, we'll start with the Simply Safe dividends. Right off the bat, a dividend safety of 69. Their yield is 1.13%, 25% dividend growth in May of 22, which is extremely strong. What do? You can look this up, but essentially they distribute swimming pool supplies, equipment, and related leisure projects in the US and internationally. Okay, why is that dividend safety rating low? The payout ratio is low. Got it. Okay, I'm going to talk about why it might look low, but really not be that low when we think about consistent earnings power in the future. Their forward payout ratio is 21%. Net debt to EBITDA is low, but net debt to capital 59%, high for most companies. That's why that rating is 69 versus in the 90s like those other stocks. Dividend streak, 17 years without a reduction. They did maintain their dividend from 07 to 09. Recession sales only dropped 14%, which is kind of incredible given the industry. But a minus 56% return during 07 to 09, worse than the S&P 500. They have a track record of strong dividend growth rate, 11 years and 17 years without interruption. So why do I not like this stock? I just believe that there has been a pull forward in demand for swimming pools over the past couple of years. As people were stuck at home, people were bored, I think a lot of that demand has been pulled forward. And I think that with rising rates, it's more expensive to get loans. It's more expensive to either move your house, buy a house, get a loan for a pool or something like that. If we're in a recession, there's less appetite for that type of stuff. So that's why I think it's risky. But just looking at the numbers, back to 07 to 09, They went into 06 with $1.74 in EPS, earnings per share. That dropped down to $1.53, then $1.22.95 through the Great Financial Crisis. I could see the same trend happening with earnings through another recession, which could take this blended PE from 20. If earnings drop from 19 to 9 or $10 per share, then this PE suddenly becomes 40, not 20. So bottom line is I think that pool core is at risk of reduced earnings into a recession because I think they've over-earned in the past couple of years, which sets this stock up to actually be pretty expensive compared to its historical norm. And we could see coming out of the recession, they did a good job picking up earnings again, but their EPS was $1.74 in 06. They didn't get back to $1.74 in pretty much until 2012. So 6 years it took them to get back to that EPS growth. Taking a look at Intuit, again, this isn't exactly fair because they were different sized businesses, but they actually never dipped in their earnings per share through the Great Recession. And then let's take a look at Nike. Same deal. I mean, Nike went from 73 cents to 95 again, and then 97. So just stronger staying power for earnings. But here's my other concern. I don't think earnings right now are realistic and sustainable. If we look in 2018, 2019, they had $5.83 a share in earnings, around $5.50. 2021, that was up to $15 in earnings. That's almost a 3x increase or a 200% increase in earnings. I just don't think that is sustainable. And if we look at Intuit, again, I mean, their earnings have grown as well, but they've gone from, around 578 or 6 in 18 and 19 to 974. So not even 100% gain in earnings. Same deal with Nike, 242, 249, up to 356 and 375. All right, so 2 things I want you to let me know in the comments. What's your favorite dividend growth stock? I'll take a look at it on this channel. And what do you think is a stock that looks cheap, it looks undervalued, but it's a value trap? Those are the 2 things we talked about. Talked about the magic of dividend growth and why I orient towards dividend growth stocks if I'm going to own them, and how that can just compound into insane yields on cost over time. So that's an important concept, yield on initial cost of shares. And then how we can think about avoiding a potential earnings trap or value trap where a stock looks cheap, but maybe their earnings or sales aren't sustainable and it's not as cheap as it might look.